Alrighty. Hey, Rockstars. Matt here. Welcome to the Epic Real Estate Investing Show, where we show people how to invest in real estate with an emphasis on retiring early. Let's escape that daily grind and retire early. So, today we're going to talk about a no money down loophole in using debt to getting rich during inflation. And before I introduce you to our guest, I'm actually still waiting for him. So, fingers are crossed. Just a quick reminder about this Saturday's masterclass in finding motivated sellers and off-market deals. If that's what ails you at the moment, this is the time to get it fixed based on what the market is doing. And if you'd like, join us and get this part of your real estate investing fixed. We need to address this part. Our marketing is actually, we're seeing the inbound calls increasing. And it's nice. And the people that are calling in when they would typically hang up over the years, they're actually now leaving messages and asking to be called back. And so that's been a while since we've experienced that in such a volume. And of course, the most motivated people always do. But we're seeing higher and higher volumes of people asking to be called back and see what we can do for them. So still waiting for our guest. But I noticed this morning. I don't know if you guys saw this for the news. Let me kind of separate this. There's that. And then let me come back over here. I saw this in the news today. Let's see. I'll be with you in a sec. It's multitasking here. There's that. Now how do I share? Come down here. There we go. All right, so share screen. Perfect. Come over here, and then let's see. It's right here, I believe is what it was. There we go. Okay, so what we've been seeing in the news is this headline right here, just 3 hours ago. Real estate mogul rips no concerted political focus to build more affordable housing. And that's a big issue right now because of the increasing interest rates. And it's pushing your first-time home buyers and much of your middle class right out of the market. And it's really slowing down the sales activity. And we could look at this from a few different ways as real estate investors. One is, and I've talked about this many times before, we've got more than a decade of a deficit in new home builds. So we're really behind. It's, people think that this is some sort of pandemic-induced real estate crisis, when really it's just a lack of building crisis. And I don't know if you've seen the building starts. They've gone down like 7 sessions in a row. Builders are scared to death right now with regard to building houses because based on supply chain and supplies and labor, they just can't build it or build anything at a price where they can make a profit. So that's why building is slowing down. And then we're also following that up with 10 years of a building deficit. That is not a precondition for anything to crash. In fact, if you just saw this today, this just came out today. Let me get rid of this. June home sales, they fell, right? They fall 5.4% from May. And that's a lot, right? But prices set yet another record. So the sales activity is declining, right? Not as many sales. I just spent this weekend in Arizona with my family, and they had some friends that came over across the street, and both of those people that came across the street were real estate agents, and they said the phone has just stopped ringing. But we continue to set records, and it's all because of the supply and demand. Sales of previously owned homes in June fell 5.4% from May. This is the slowest pace since the same month in 2020 when sales dropped very briefly at the start of the COVID pandemic. And the median price of an existing home sold in June set yet another record at $416,000. That's an increase of 13.4%. So if you are owning real estate already, you're in good shape. If you don't own any, you probably want to start buying some and investing some, specifically income producing real estate, because the prices will continue to go up because the supply is just crunched and there's nothing affordable. And the interest rates are continuing to go up. And what's funny about that is that might be pushing some people out of the market with regard to their affordability. But actually, cash sales are up. So there's plenty of people in the market that said, "Screw the mortgage rates. I'm just going to go pay cash." And I covered that last week. And then here's the grim outlook for housing market the CEO warns, because they can't build them cheap enough. So they're not building any more homes. So that's just not a condition for us to have any sort of crash, even a correction, which is remarkable to believe in these times. But Kevin, hello to you. Good to see you. Good afternoon from Lakeland, California, Florida. Excuse me. I used to live in Lakewood, California, so I was thinking that real quickly. All right, so my guest isn't here. I might have to reschedule. If you got any questions, let's take some time. I was scheduled to be here anyway. If you have any questions about the market, I'm really big on looking at all of the economics and looking at what the news is saying, and then what they're stating the facts with their statistics and the growth and the declines and all this kind of stuff. But what's actually happening is that prices continue to go up. The stock market is down, the Dow is down, the NASDAQ is down, and people are scared there. Crypto is down, and and the other thing, but this inflation thing, the inflation is up 9.1% per the last situation, or the last report. It's last week, I guess. You got to get on the right side of this economy, because inflation is going to absolutely crush you, particularly if you're an employee and that's your only source of income, or if you are a retiree on a fixed income from your investments. Those two people are going to get crushed the most. And if you don't have real estate to hedge against this, because the appreciation is going up still, the rents are going up even faster than the appreciation now, which historically speaking, I don't think I don't remember that ever happening. I did some research. I've never seen it happen. Usually rents are about a 3-year lag behind the actual house prices. And so, you've got to have something else working in your favor, because we're just can't do it all on our own. So if you got the assets that are producing income, the assets that are appreciating, that's how you're going to survive. It's kind of how you're going to actually thrive, but you got to have at least some. Let's see what you got, Luke. Luke, how many properties do you own currently or are invested in? Good question, Luke. I've got about 50 houses and about 50 notes ish. I got all the way up to about 350 properties here, I don't know, about 3 years ago. And then I just started really consolidating and going ahead and getting rid of the ones that were the property management headaches, selling some of those and transferring those and paying down some debt on the ones that I currently own. And so now I got a bunch of nice properties. A lot of them, which was always my goal, a lot of them I would actually consider living in. Most of my income properties when I got started, I wouldn't have lived in those, but they were nice little cash machines and they helped me build. But we've got it to this point now. Alrighty, so thanks for the question. Okay, so anything else? I can't believe our guest. He said 100%. I hope hopefully everything's okay. I'm gonna check my email real quickly. If you got another question, let me know. If you don't, then we're just gonna have to reschedule. Bummer. This first time this has ever happened, but here we are. Okay, let's see. Luke, got another question. Good. Let's take advantage of this time together. So I just turned 18 and I'm trying to do all the research I can. What is the advice you would give me starting out? Okay, so there's two things. You are 18, right, Luke? One thing I wish I would have done the day I turned 18 was to go and buy a house using my FHA loan. So I don't know what market you're in, but for most parts of the country, you can do that for less than $10,000 down. Even if I had to get a co-signer, and just did that. And then if I had trouble making those payments, I had to rent it out the rooms. They call that house hacking these days. That's kind of the new expression. But I would have rented those out, and that would have been a good start. And it doesn't have to be a perfect house. It doesn't have to be your dream house. But it will get you started. And once you're ready to move up, you're going to keep that one. You turn that into a rental, and then you can go use your FHA again. And you can just kind of play leapfrog. And gosh, Luke, if you did that, you're 18 years old, and you did that once a year for the next 10 years, you probably wouldn't have to ever work again. And you could be retired essentially by the time you're 28 years old. And you don't have to make a full-time business out of this. You don't have to put forth any extraordinary effort. You just got to keep on saving those little 3.5% down payments with your FHA. And that your credit, it doesn't have to be perfect. I think anything above a 560, 580 is 3.5%. If you're below 580, I think you have to come down with 10%. But still really, really low. And gosh, if I would have done that, so I'm 4 to 52. So that's 18. So I've been 28 out at 10, 30 out 10 more, 48, 10 more. If I'd have just done that, I would have never had to become like a full-time real estate investor. That'd be 30 properties if I did that just once a year. If you did it once every other year, That still would have been 15 properties. Imagine if you bought 15 properties 15 years ago, 20 properties 20 years ago, 30 properties 30 years ago. You know, uh, life would be really, really good. Thanks for the question. What's this one? Maximo, when you say notes, do you mean lease options or land contracts? Very good. When I say notes, this is what I did. When I bought all my properties, or I had all those 350 properties, and I was just like, a lot of it, I mean, I'd say a good 10-15% were real management headaches. I was constantly getting turnover. I was constantly putting money in these properties to fix them up. I was constantly getting calls from the property manager about these deals or about these properties. So what I did was I started to reallocate and kind of just reorganize. And I did the 80-20 rule, where I focused on my 20 favorite properties that gave me no headaches and produced the most money. And so what happens there when you start owning a lot of properties, and this is a long answer, but I'll tell you why I did it, Maximo Digital. Is that your God-given name? What an ingenious and creative parents you had. But when you have that many properties, you start showing a loss on paper and you virtually eliminate your tax liability. And so what that means is you've got all of these losses carried forward. And if you never make the money, you never get to actually use them. And this is like why someone like Donald Trump, who knows how much money he has, millions, right? Some say he's a billionaire, but it's the reason that he only has a $700, $800 tax bill, the one that became so famous. And it's because he's got all of these losses he's been able to carry forward. But you don't need to have millions and millions of dollars in real estate or be a billionaire to be able to maximize that tax advantage. Once you get 3, 4, 5, you're going to start experiencing that. So what I started to do was I started selling some of my properties with seller financing. So I'm actually holding the notes. So they're not land contracts. I'm actually holding a mortgage note recorded against the contract, just like a bank would. But and now I don't have the property management headaches, and I still have passive income. And it seems like a great strategy. And there's a couple guys on YouTube and podcasts and stuff that say that's the best strategy. Buy the house and then resell it with seller financing. But it has its disadvantages too, because one, as you're receiving payment for those notes, your asset is getting smaller and smaller and smaller. They're paying down the debt. So your asset, you're not getting wealthier that way. You just got nice passive income. The second thing is it's taxed at a much higher rate. So it's taxed, the money you receive from your notes versus the money you receive from your properties, it's taxed differently. So what that allowed me to do was every 2 years or so, my CPA and I will get together and we'll do a balance of how many properties I own and how many notes I own, and try to get those to a point where I can maximize the money from the notes without having to pay taxes. The properties offset that. So that's not even the question you asked, but I gave you a real long answer as to why I've done that. But thanks for that. Let's see. Frederick, have you used Pretty Software? It's a direct MLS software platform used. Yes, I just got a free account, and I'm doing this marketing masterclass with Benson, the owner, this weekend on Saturday. And if you'd like to join us, you can at reimarketingmasters.com. I'm really interested in it, and he's done a great job at putting this together. He's got a lot of fantastic information, stuff that takes, a lot of research and a lot of clicking around to determine you're on your own. And it seems to be a real time saver. And he's been wholesaling properties on there too as well. So I can't wait to learn about that. And I guess, maybe if inventory rises, there might be a lot more opportunities on the multiple listing service. I haven't played too much in the world of on-market properties just because all the competition is there and typically got to pay more. So I like off-market properties. But that's one of the things we will be talking of 7 different things this Saturday. And you can go to REI marketingmasters.com. So it'll be myself and 6 other multi-millionaire real estate investors showing everybody what's working for them. All right. But good question, Frederick. I don't have a lot of experience. I just got my account last week. So I've been poking around and it's looks pretty cool. But I'm waiting on Benson to give me the practical use case for it and how he's been able to pull it off. All right, y'all. Well, it doesn't look like our guest showed up. I've been stood up. First time ever here on YouTube. But I guess it happens. Hopefully everything is okay with them. And Claude, good afternoon to you too. It's afternoon. It's still morning over here in Lost Vegas. Lost Wages. All right, y'all. I wish, sorry about that. I will reschedule and we can do this all over again with no money down and how to get rich in inflationary times. I will give you one piece. You don't even know how it works, but if you're buying income producing real estate, you will get rich in inflationary times. Specifically, if you're borrowing or using other people's money to buy those assets, that's the best thing you can do. It checks all of the boxes. It puts you on the right side of the economy. It puts you on the side of the Fed. There's that famous expression, don't fight the Fed, right? So your property's going to appreciate, and it's actually outpacing inflation. Your rents are outpacing the property appreciation, so those are outpacing inflation. And borrowing money to buy those assets, the inflation is destroying that debt. So it's like a triple whammy. So if you own real estate, you are income producing real estate, you already know the advantages of this. If you don't, you better get some. Got it? You got to get it because there's really nothing else out there available to the average person that can check all of those boxes by one thing. And you just have to own it. You don't have to do anything. You just have to buy it and manage it. All righty. So let's see. Frederick, thank you for the question. Good to see you. Please come back. Click like if you like it. Like this video. Even though it's not what we always promised. Click the subscribe button so you get notified when we put the next ones out. Chill Cat Haida. Good. Hopefully I'll see you on Saturday. And Guillermo. Peace, blessings, and God loves you, and so do I.